All right, guys. So we are back today. We got Big Papa Jerome Powell speaking in about an hour. So let's get the music going. Let's get ready. Big Papa Powell speaking. You can see market is Tesla's down all the way down at 220s. Netflix is at 398s. 398s. So again, we'll see if we get anything good. Here's the SPY. You can kind of see the SPY dipping down a little bit. My wife just joined the stream. Hey, baby. We just started the stream. Jerome Powell speaking. So again, if you haven't already, hit the sub button, hit the notification bell. We just started up. We're going to get everything ready here. And yeah, should be a fun stream. We'll see. We're going to do a poll like we always do. Will Powell help or hurt the markets, guys? Let me know. I'm not sure whether it's going to be good or bad for markets. He is speaking at the Economic Club of New York. The Economic Club of New York. And yeah, again, subscribe if you haven't yet. Hit the notification bell. We appreciate the love. Thanks so much. And again, we're going to get this ready. Ready, guys. Powell speech coming soon. We'll get a timer up as well. All right, sorry, guys. But yeah, so just me and my red portfolio. I'm actually green on the day somehow. You know? So I'm actually green on the day right now. All right, team. Again, Netflix helping the market right now. Tesla down. Somehow I'm still green on the day despite all of this stuff. Again, you can kind of see we're still up in our portfolio about $104, $105. So not bad. Doing okay today still. We're gonna get a poll going like we always do. So not bad. Again, we just started the stream up. You have a bearish or bullish stance. Bear. Bull bear. Let me know what you guys think. Bull or bear. We're gonna get that poll live. Vote on the poll right now. We just got that live. We're also gonna do a poll. All right. So again, Powell speaks. Will he be dovish or bullish, or dovish or hawkish? I'm not sure. You can slap the like button already if you can't. All right, 55% think he's going to be bullish. Interesting. All right, so we got this speech live too. Let's look at the chat. Let's go Tesla. Let's get a time or two. Yeah, for sure. We got 55 minutes. All right, so here's the timer. And again, the full speech will be streamed live. So yeah. Put this up here as well. Again, he's supposed to speak at the Economic Club in New York. The SPY's still down at 429s. Looking at our polling numbers so far, most people think he's going to be bullish. Or we at first bullish, now bearish. What's a yellow check mark do? Nice. We got a couple of votes here already. Most people are dovish on Twitter. Bond yields are something people have been freaking out about recently, and for good reason. I mean, bond yields are pretty high. They have been high for the last couple of days. You can see right now they're at about 4.94%, so almost 5% bond yields, which is crazy high. Again, if people are earning so much on bonds, they're not going to buy equities, and that's why there's an inverse short-term relationship with these. Some of these posts on Twitter are funny. When you're a double income, no kid household that still can't save enough money each payday to buy a house because of the rising cost of living. But 78-year-old Bill, who bought his house for $12.99, tells you to simply stop buying avocado toast. Dude, I love avocado toast personally. Like, I'm a big sandwich guy. PB&J's, of course, are at the top of that sandwich, hierarchy. But avocado toast is good, dude. It doesn't make me snooty either. All right, Generation Z may be permanently psychologically scarred by high inflation, according to Bloomberg. Netflix. Where's Netflix at still, man? Again, there's bond yields. SPY's very choppy. Everybody's scared of Powell, dude. They look at Powell like the wrecking machine he is. And again, here's Netflix. Still up around $400. There's Tesla at 221. All right. Daddy Powell gonna make it bleed. I gave the kiddos $20. They used to go to Myrtle Beach for a couple of hours and they came back scared. $20 isn't much, they found out. Hey. Yeah, dude. My parents don't understand. I don't know. My kids still think, and I'm going to tell you this, okay? And I'm going to preface what I'm about to say with like, look, I am not trying to sound snobby. Okay, I'm really not trying to sound snobby. All right, like I'm really not. Okay, I'm not trying to say I don't value money. All right, but one of the most depressing things ever, right? One of the most depressing things ever is like, okay, I used to sell books, right? A lot of these books, like if you look at this, like look, I got this whole library. I used to sell books. You know what I mean? Like I used to sell books. And like, bro, when I used to find a book that was worth like $30 that I was buying for $1, I used to get excited, man. I used to be like, ooh, you know, I used to be like, ooh, you know, we got a deal here. Like I used to get excited for the money. At this point, you know, when I was young, when I was in my 20s, you know, $500, if I had $500 in the bank, bro, I was super pumped. You know, well, one of the most sad things in the world is slowly over time realizing that that's not that much money anymore. You know, I'm not saying $1,000 is chump change. What I'm saying is like business changes the way you look at money. It really does. It just changes the way you look at money. And I think inflation has made everything worse and scary. Yo, are you hawkish or dovish? I don't know, man. I don't know what Powell's gonna say. I don't know what he's thinking. You know, we got the next Fed meeting in like 11 days. We'll see. I don't know what he's thinking. Daddy Powell gonna make the market green again? Maybe. FBYD running here. Weird stock being gonna move. Tesla tanking now. Powell's gonna finish it off. Maybe. Tesla went skydiving without a parachute. Yeah. Sorry, Big Papa Bruce barking over here. I'm gonna yell at my kids saying, "Stop it!" I'm not like mad. I'm yelling so they can hear me. Bitcoin is pumping hard. Is it really ahead of this Fed meeting? Bitcoin, BTC, Bitcoin at 28.9K, almost to 29,000. Again, Nvidia sideways. Nvidia had a rebound. That's kind of what saved the market. Is Nvidia bounced back? Nvidia was looking kind of red at the opening bell. It dipped all the way down to 422s, 421s. But again, Nvidia kind of helping the market here, kind of saving the market some. Again, will Powell have a hawkish or dovish stance? I'm not sure. I hope he has a, you know, bullish stance, dude. I hope he does. All right, team. Again, Powell's speech coming soon here. Again, we got the timer up. We still got 45 minutes. The SPY is very, 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 very flat ahead of all this stuff. We are very, very sideways, very, very neutral. And again, Tesla's starting to crack lows here. So look at Tesla still breaking down. It's at 220s right now. This should drag the market back down. But again, we'll see if it does. There's a bug in iOS where sometimes we can see how ChatGPT interacts with DALL-E and natural language. And well, Yeah, it's interesting how these AI models talk to each other. Yeah, we got 150 here. Slap the like button. Yeah. Bro, all stock YouTubers do it too. They can hate on it, but like everybody does it, dude. Yeah, bonds are ripping up, dude. Honestly, I might buy some bonds. I'm not going to put all my money into bonds, but I might buy some. Again, slap the like button, hit the subscribe button. Let's grow this channel. Alec Torelli says 10 ways to virtually guarantee you're going to lose money in poker. Tilt, limp call, limp fold, play tired, 4-bet nits, bet sports, play drunk, play the pits, bluff tourists, call river raises at 2 and 5, no limit because you're top of range. What else? People are arguing about whether sports betting is powerful or not, or like profitable or not. I told you guys once, and I'll tell you guys again, dude. The problem with sports betting is very, 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 very simple. Okay, it's very simple. The problem with sports betting is that if you're good enough at it, you get kicked off. Right? If you're actually good at sports betting, they boot you off, man. They're not going to let you keep playing. If you're actually good at it, they don't want your action. Like, they're going to boot you off of there so quickly. If you're good at sports betting, it doesn't even matter. So, like, why? Like, why try? Like, again, people get wrapped up in it out of delusions of grandeur. But you're going to get booted off anyway if you're good enough at it, man. With a 7% month-over-month subscriber growth, maybe it's IPO time for beginner trading. Well, subscriber growth fluctuates. It just depends on what goes on. You know, like big economic months, we get a lot of subs. Lesser economic months, we get lesser subs. Either way, like we go pretty consistently. All right, so again, look at Tesla. Tesla's had 1, 2, 3, 4, 5, 6, 7 red candles in a row. 7 red candles in a row. Still breaking lows down to 219.60s for Tesla. Not looking great. Again, somehow I'm still green on the day. Best Buy CEO Corey Berry has said we're in a funflation economy. All right, Tesla just cracked lows at 219s. Looking pretty weak. Pretty weak. Again, the interesting thing to watch today, though, is, again, the Cybertruck debut is November 30th, right? So we got roughly a month and 11 days until the Cybertruck debut. And so, you know, Elon Musk's no stranger to dumping the stock and making it cheaper for him to buy up more shares. You know, and if he believes the Cybertruck debut is really going to do some stuff, it's not going to be surprising that, you know, it might dip. I'm not saying you should buy it. I think it's incredibly risky right now to buy it, but sometimes big risk pays. And, you know, we'll see what happens. AMC shooting up a little bit today, still under $10 at $9.60, still at a pre-split price of 95 cents, 96 cents. And so it's still got a long ways to go. We still got 50 minutes left, 40 minutes. I mean, another hike. I don't think we're going to raise rates next cycle here. If we look at this, I don't think we're going to raise rates next cycle. You can kind of see the expectation is 96% think we're going to pause or skip. So again, we're currently at 525 to 550 in terms of rates. And so again, you can see by the CME watch tool that a large majority of people think we're going to pause. We're going to stay paused during the next Fed meeting. You know, only 4.1% of people here think we're going to raise rates 25 basis points. And so it's incredibly unlikely that we're going to raise rates during this next cycle. And I'm not saying surprises never happen. I'm saying right now it's incredibly unlikely. I think it's more probable that we skip this next meeting in terms of rate hikes and then raise rates late in December. I think that makes the most sense. You know, I think the market's going to be the most immune to that, more resilient to that, I should probably say, just because of Santa rally potential and stuff like that. I think that's kind of what's going to go down. Yeah, the problems overseas are scary. Again, Powell, guys, we got 40 minutes. We got 200 here. Slap the like button. Let's keep the growth up. Is Powell a bull? I don't know. Wait for crush. TLT. What is that? The 20-year yield, right? Yeah. So pretty flat on the day along with everything else. Man, I might just keep this camera angle. All right. Again, hit the live button, hit next to the play button. We're going to stream the full thing live at 12 p.m. Eastern Standard Time. We're getting ready for this now. Prepare. Let's look at our polling numbers here on Twitter. We got some votes. 73% are dovish, or I think Powell will be dovish. 27% think he's going to be hawkish. You know, if you don't understand the difference between dove and hawks, right? Hawkish means contracting, right? A diving monetary policy. That's the way you think of hawkish, right? Hawkish, diving, right? A contracting monetary policy. When we mean contracting, we mean more aggressive rate hikes, more restrictive monetary policy. That's what hawkish means, right? Dovish means fly, freedom. It's symbolic of freedom in that regard. And so, yeah, dove means an expanding monetary policy, which means rate cuts, pauses, less aggressive rate hikes, so forth and so on. Generally, the Fed is dovish if they believe inflation is under control. Generally, they are hawkish if we need to do more for combating inflation. And again, looking at the past month of September, retail sales came in higher. There's a lot of potential inflation bad signs with all this stuff going on. So again, with all the stuff going on right now, I think it's possible that let me fix this. I think it's possible that the Fed stays pretty hawkish moving forward. And if that comes out, but the Fed also does their best to be balanced, right? Like they try to be balanced. They don't try to be crazy aggressive. They try to stay balanced. The TLT just ripped up over highs. Again, the thing tanking the market right now is Tesla. Again, Tesla down big, SPY down mostly from that. Nvidia neutral, Amazon red since the open, green still on the day. Apple consolidating right at the previous closing price, like right at the red to green, green to red level. They're consolidating here. All right, again, Big Papa Powell speaking soon here, team. So we can give you some expectation potential for this. All right, team. So we still got 35 minutes until this report drops. And again, it's a live speech, and then they're going to do a Q&A. Again, they are going to be talking about the economy, and so we'll talk a little bit more about this Powell speech live. All right, so yeah, Powell's not going to close off a December hike, although Waller raised the bar. So Chris Waller had a speech yesterday where he raised the bar for a possible interest rate hike in December. That's what I told you guys. I don't think we're going to raise rates next month, November 1st. I don't think we're going to raise rates in a couple weeks. I think we're probably going to pause and then raise in December is my guess, because inflation is still a problem. That's my guess. Let me know what you guys think in chat. Do you guys think we're going to raise rates November 1st, which is the next FOMC meeting? Do you think we're going to raise rates? I'm not sure. I think we're probably not. I think most people voting think we're not going to as well. I think the more likely rate hike is going to come in December. Yeah, and again, Waller laid out two different, possible scenarios for the U.S. economy. One where growth slows down a little bit, allowing the FOMC and the Fed to extend their pause. The other option is where growth is resilient and the Fed has to hike more to bring inflation back down to their target goals. They said the Fed likely won't know for sure where the economy is headed even by its meeting in mid-December, so a pause would be natural. But they're not going to basically exclude the potential for a December rate hike. And, maybe we'll get a refresh or a restate of that sentiment today based off of what Waller said yesterday. I think that's definitely a possibility. The risk is that Powell can, go away from any real direction guidance from November. And so, yeah, we'll see what happens. Again, let me know what you guys think. Pause or crash? No, I think I don't think if we raise rates, we're going to crash. Powell could probably hacky sack, top 3 hacky sackers in the world. Netflix is on firm footing to float back up to the 500s eventually. Yeah, I think so as well. I mean, I think Netflix has been incredibly resilient. I told people before, what's really interesting, guys, is I told people about Netflix, man. I told people about Netflix over the last couple months. Really since September, we've had a pretty big drop in Netflix. And so I was talking about this prior to their earnings yesterday. I told people I like Netflix. I actually bought Netflix a week ago. Prior to their earnings report. And again, my argument for buying Netflix is simple. Netflix has dropped from 480s all the way down to 340s prior to their earnings report. So from 480s, almost $500, all the way down to 340s since July. So they've had very big, very extended, very deep pullbacks since July. And so extension plays a factor here. Netflix, incredibly strong. Almost everybody in the world has Netflix. They were going to make money from their password crackdown, and that's exactly what they came out with yesterday. And so in that regard, we bought Netflix and were able to make, pretty good little return from that dip buy we got involved with. My average price in the 380s, 370s. So we'll take it. We'll take it. And again, you can see as we're talking about this, the SPY's starting to bump back up. Again, we're at 429.50s right now, 429.50s. Dang, dude. That kid has some hands for sure. Bro, it's a scary day to be a kid, dude, nowadays, bro. Like, the problem nowadays, dude, I did some dumb stuff when I was young. Like, I think everybody does dumb stuff when they're young, man. Nowadays, you got cameras freaking everywhere, dude. And all I'm saying is I'm glad we didn't have cameras back then. You know, that's all I'm saying is I'm glad we didn't have cameras back then. I like phones. I think phones can be a massive benefit to people. You know, you don't have to work at a conventional job if you don't want to. Like, you could do a lot of benefits with it. But I also think it's hard to be free nowadays. You know, don't be surprised if we rip. What's up, bro? I'm back. Puts at 365 in the queues. Was nice at the open. VMware taken. What is that? VMW? Yeah. Yeah, VMware down to 150s. I don't know enough about VMware. The only way I know of VMware is I know a little bit of penetration testing. But I don't even know if I've dealt with them a little bit in terms of that. In terms of pen testing, but yeah. I don't know enough about a company to really say. All right, guys. So the SPY has had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 green candles in a row, except for this little doji candle. But just for the sake of the argument, we're going to call it green. Why is GameStop trending? GameStop all the way back down to 1320s. What is GameStop earnings here? GameStop earnings December. Did I miss the last GameStop earnings? Oh no, the last GameStop earnings, we didn't cover it because they didn't do an earnings call. The GOAT Donald Duck song. All right, I need new music here. Sorry, guys. I'm going to keep scrolling. I'm going to find some new stuff here. This is too much. I'm going to put on another song just for now. All right, so we finally got a little dip right at the 200 EMA. Apple started to break down as well. Again, we'll see what Powell's tone says. No, that's one. Still got 27 minutes left. What do you think? What do you think Powell's saying? I really have no idea. I think Powell a lot of the time tries to stay balanced. Like, he tries to be balanced, right? He never is completely, but he tries to be balanced, right? And so I think, yeah, I think he's going to try to stay balanced. And so, you know, what we can look at again is last month. So last month, retail sales were higher. Economic growth was certainly there. Retail sales were higher, and, you know, job numbers were high. So payroll numbers were high, job numbers were high, retail sales numbers were high, inflation struggles seem to be there, right? And so in that regard, I would say, excluding the recent market activity, which Powell is certainly going to be paying attention to, he might be hawkish. You know, now we don't know for sure, but my guess is he could be hawkish based off of, you know, based off of what we've seen economically over the last month and a half or so. You know, again, numbers are there. Let's go bull already, maybe. Do you anyone know what the next level of support is on the Qs? All right, guys. Again, we got 25 minutes before the speech. Here, bear with me 1 second, guys. Look at the SPY rip. All right, guys. Powell speech coming soon. All right, guys. Again, we're at 4:30s on the SPY. 4:30s. Powell speaking soon. Be ready. Let's get ready. Amazon earnings 10/26. Yeah, Amazon next week. We got Amazon, Apple. We got a gang of earnings next week for sure. Like we got a lot of different ones. I feel he'll be hawkish, but we'll probably tread carefully with all the new tension built up overseas. Yeah, that's probably true. I mean, again, balance is a big thing. Like they usually try to stay balanced, you know. So again, Powell's Powell's speech starts pretty soon. Again, slap the like button here, guys. Let's break 100 likes if we can. Amazon earnings 10/26. Yeah. So again, next week, guys, just to put this into perspective in terms of the earnings dropping next week, Cleveland Cliffs, a bunch of other big ones, Coca-Cola, Verizon, Microsoft, Google, Snapchat, Visa, Teladoc, Texas Instruments, Boeing, T-Mobile, Thermo Fisher, Meta, IBM, Baker Hughes, United, UPS, Altria, Southwest Airlines, Amazon, Intel, Ford, Chipotle, Skechers, U.S. Steel, Exxon Mobil, Chevron. So those are all the big boys next week. There's more than that. There's way more than that. But those are the major ones that we see here for sure. And again, guys, stick around. Powell speaking soon. So again, stick around. Powell's going to be speaking soon. And we got 22 minutes until Powell's speech. Might buy genuine parts. Yeah, we'll put the music up here so you can hear it. I feel like look up the Q cheat sheet. Yeah, the Q. I mean, when we take a look at the Q, right? And a lot of time I'll look at the Q. I also trade the Nasdaq pretty heavily, day trading. The Q, we got a slight downward trend today, so it could be worse. This bounce up makes it look like the trend's even more obvious. And so when you look here, like we see a really obvious trend. So we see a really obvious trend here and here. So let me see if we can get a better percentage, 17.6%. Oh my gosh, dude. All right, let me remove this. Remove this. I'm clicking buttons over here. There we go. So that's the same trend. And then we could go like this, right? So here's the trend that we've been in basically all morning. We have this previous low down here that I think is very relevant. And just to put this into perspective, right? Y'all can hear the music, correct? So you should be able to hear the music live. There we go. So this is the trend we're currently in. So you can kind of see this is a big spot that we're in now. Like if you look at this level specifically right here on the Q, right? This is, you know, a huge level. Why is it huge, right? When you think about this technically, okay, it makes perfect sense to watch all this, right? Number one, we got the previous close, milestone technical level. We got the 200 EMA, milestone technical level. We got the volume weighted average price, milestone technical level. And then we also have the top of the trend line up here, milestone technical level. And so in terms of resistance here, we've got a lot. Now, again, economic reports generally trump any type of technical move, but we can't ignore this big level right here on the Q. It's also kind of there on the SPY, in all honesty, as well. So like if we look at this, it's also kind of here on the SPY too. You know, it's not as nice of a trend on the SPY. I think the Q trend is a lot more clear. But we do have this big technical level where we have all these major milestone levels, the VWAP, the 200 EMA, the previous closing prices at the top of that trend line that we've seen this morning. Now this is a 1 minute chart, so it might be different, looking at other stuff, but yeah. Again, we got to get ready for Powell speaking. We are waiting here. Yeah, this is from the Economic Club of New York. And so, again, we still got 20 minutes left. We got until noon. I see GameStop bouncing back. Again, NVIDIA is another one that's been helping the market. And again, there's the SPY rip back up. We do have all these levels here. The previous closing price on the SPY is right there. So again, you can kind of see the Q approaching this level. Again, we are waiting. Let's put this up. Let's post this here. Put the SPY. Would y'all rather the SPY or the Q? I guess we could put the Q up since we've been talking about it a lot. SPY or Q, guys? Let me know. Let me get this up here so you can see it. Put another little chart up here so we can kind of get everything. Help you guys out a little bit. What do you want? Bitcoin? We can put the dollar index. We can put gold up. Here's NVIDIA up here if you want to, kind of get a little gauge of it. There we go. Get a little look at everything here. We're ready. Q. All right, gotcha. All right, so here's the NASDAQ. Again, we're approaching that trend that we had earlier, heading into this report. No, not really aid. All right, again, we're patiently waiting here. We got the video waiting. They just got cheesy hold music going on right now. Yeah, well, Bitcoin's interesting. We're going to see what happens with it. Again, Bitcoin currently at about 28K, 29K. We still got 20 minutes until this report starts, so we still got some time. All right, guys, you ready? All right, Big Papa Powell coming here. Are there any AI thumbnail creators, guys? Any AI thumbnail creators? What do you guys think? Again, there's Q testing that trend line we talked about. NVIDIA is bumping up to 430s. We can also put Tesla up if you guys prefer. Is there new AI? Big Papa's off. Is this the Federal Reserve right there? So that's what this is, the Federal Reserve. Sorry, my dogs are spazzing out, probably landscapers. Great. My landscaping guy's showing up right now. Hey, they're right by my desk. Again, will the market hold? Will the market react positively or negatively to the Powell talk? Let me know what you guys think. A lot of people are thinking bearish, although look at the Q start to rise. So the Q now broke over that major level we talked about. It broke over the VWAP, over the 200 EMA, over the previous trend line, over the previous closing price, and the Q is starting to rise. NVIDIA is approaching 430s right now as we speak. So NVIDIA is getting closer to 430s. Like we can zoom in on that here. So again, you can kind of see 430s right there for NVIDIA, and it's creeping up. It's trying to rise here too. And so the movement is we're trying to move here. We'll see if it happens. Any idea what's going to happen to gold? Well, it depends on what Powell says. Gold most of the time follows the market. Most of the time. Now, short-term fluctuations can be wildly different than the market, to be honest. So most of the time it follows the market, but it doesn't always have to, and there can be a lot of nuance behind it as well. But ahead of this report, we're starting to run a little bit ahead of this report. We still got 15 minutes before the report. We got about 400 people here. And so as we're saying, does the market run ahead of today's speech? I'm not sure. Pump and dump as usual. Yeah, we can look at gold. Gold has been on a crazy run. Like I'm gonna put gold up above the chart here. So look, here's gold. Gold has been on a crazy run, man, and today's no exception. It's all the way up to 1970s. So I think weakness in banking the last couple of days, as well as weakness in like Tesla, has influenced the market. But gold has been pretty sturdy, moving up to 1980s, 1990s here. So it's been moving a lot. Hey, what's up, Yelton? Thanks, brother. Again, does the market move on Powell's speech? I don't know. I mean, it's going to move almost certainly because, like, this is it. Like, there's a lot of speeches Powell does where he doesn't talk about the economy. He doesn't talk about the market. This is a speech in which he is absolutely talking about the economy, absolutely talking about the market. And you know, there's a blackout period ahead of the FOMC meeting. You know, the next FOMC meeting is going to be on November 1st, right? And so, in that regard, there is a blackout period ahead of these reports, in which, you know, it's really important because there is a blackout period ahead of this. And so he's not really going to say anything about the economy after today. So for the next couple weeks, we're going to have a blackout period in which he's not really going to be able to talk about monetary policy, financial decisions, hawkish, dovish, all that stuff. And so this is his last word before the next FOMC meeting. Again, there is a blackout period. Yeah, I don't know whether you should buy or sell Bitcoin. Study of career. I have no idea whether you should buy or sell BTC or anything like that. Nobody does. Nobody knows how crypto is going to react to it as well. What I do see short term is that the markets are starting to rise here. Specifically, Nvidia is going up. The SPY is moving up. The Q is moving up right now. So we are seeing, you know, a surprise bump in equities right now based off of everything else. So we are seeing some increases here in everything going on. We still got like 12 minutes, 11 and a half minutes until the actual speech from him. But again, I am starting to see a bump up right now. Powell the Fearless. Where was Powell in 2008 when TARP free bailout money to banks? Yeah, I mean, hey, Powell has only been the FOMC leader since what, like 2018? 2018, yeah. So February 2018. So I was right. Yeah. When since I cover him so much, I learn a lot about him. You know, Powell's net worth is 55 mil. You know, you got to understand, Powell was an investment banker prior to becoming the Federal Reserve member. So he was a banker, you know, an investor, a banker, you know, a stockbroker. I don't know. What did he do? Maybe he was a broker. Maybe he was an executive. All right. So Powell served as an assistant secretary and undersecretary of the Treasury under George Bush. He worked as a lawyer and investment banker in New York City. So yeah, he was a lawyer and an investment banker. Yeah, Powell's a partner at the Carlyle Group, where he founded and led the industrial group with the Carlyle U.S. buyout fund. After leaving, Powell founded Severn Capital Partners, which was a private investment firm focused on specialty finance and opportunistic investments in the industrial sector. That's where he got rich. Again, the Q at 364s. So the Q is at 364s. The SPY is at 430.40s. So the SPY bouncing back. SPY is actually technically green on the day right now. Technically green on the day. We still got 10 minutes. All right, team. All right, so we are starting to dip a little bit on the versus the volume weighted average price. Again, Powell's speech is going to be starting pretty soon here. Pretty soon. Again, the SPY dipping down. We're at 430s right now. 430s. NVIDIA right at 430s. So what's interesting is that the SPY and NVIDIA are roughly at the same level. Starting to dip down. Here's gold at the top. Would y'all rather see gold or something else? Based off of this report. Gold or something else? Yeah, a lot of people think he's doing better than Bernanke, but there's just a lot of stuff going on. How long did Bernanke reign? Bernanke was from 2006 to 2014. So, yeah, I mean, Bernanke just had the mortgage crisis under his hands. Again, there's 364s. So again, the Q holding right over that level. We broke over it. Now we're holding. Again, we got gold right here. Still waiting. Nothing started yet. Again, we're going to cover the full stream, full speech live like we always do right here. So we still got a couple minutes. Be ready. Again, SPY still technically green. Let's see what Tesla's doing despite all this stuff. So again, here's Tesla. Tesla at 222s, 221s, 218s. So Tesla's trying to rise, but it's still pretty down on the day. It's over. Tesla has a really obvious trend too. Like I think when we look at this, you know, we have to see this right here. You know, maybe a closing trend right there for Tesla, but starting to bounce back. You know, the last 5-10 minutes have been pretty green and everything, including most equities, including Tesla. So, but again, you can see the SPY at 430s. You know, 431's way up here is the high. Gold still up there at 1970s, 1960s. Insider stuff, how they get rich even when they say they locked up. Yeah, I mean. All right, guys. So again, we still got 6-7 minutes left until this number starts. Gold starting to dip down some. In the span of 2 years, Tesla's only had closed down 9% plus 2 times. What's up, Sid? Again, the SPY up there. Again, we did a poll on both Benzinga, or not Benzinga, on we did a poll on both YouTube as well as Twitter. All right, so there's the SPY. SPY is technically green. You can kind of see gold. Like, people always ask what's going to happen to gold. What's going to happen to gold? A lot of the time, these move simultaneous to each other. Not like they have sympathy with each other. So again, if we look at like the SPY here, if we look at the SPY right here, and don't worry, you're not going to hear my dog bark. I'm going to mute myself when the conference starts, so don't worry. But you look at the SPY, and then you have gold right here. You can see big upward movement and then a dip. You can see a big upward movement and then a dip. And so a lot of times these kind of similarly follow each other. Markets are trying to hold their gains based off of where they were. And we still got like 5 minutes left, 4.5 minutes left. Well, yeah, I mean, Big Papa Prince, he is what he is, dude. He is what it is. I'm not even mad. Sometimes we got to print money. That's part of the Fed. Again, still waiting here. You can see nothing started yet. Still waiting. We got 4.5 minutes left. About 700 here. As we get closer, more and more will jump in, and we'll have well over 1,000 people here during the speech. So, again, Bank of New York, Economic Club of New York's the one holding this event. Again, bull or bear? List in chat right now. Are you bullish or bearish on this report? Well, I'll list mine. Hey, what's up, Ollie? We're on today's Powell speech. Bullish or bearish? You bullish or bearish on today's power speech? Let me know. Again, there's the SPY dipping down. All right, guys, 3.5 minutes, a little bit less than that, actually. So, again, you can kind of see the SPY or the S&P bouncing right at the 200 EMA volume weighted average price level. We can look at the NASDAQ here and see the NASDAQ's still well into green territory. It's still pretty flat on the day. It's not like super green, but it's not close to red like the SPY is. The tech, that means that tech is outperforming the S&P. The tech is outperforming other sectors a little bit more today is what that means, because the Q is a little bit more tech heavy of a fund. Again, gold is up here. We got the Powell speech right here. We're waiting for it to start again. This is completely live. You can see the red button. And with that said, you want to make sure you hit the red button. You want to make sure you hit the live button next to the play button. Since we still got about 2 minutes left until this starts, I'll go ahead and say this now just so people can catch up in time. But again, you want to make sure your live button looks like this. You want to make sure your live button looks red like this. It's red. It's live. That means you're fully caught up on stream, and you'll be able to see the live price action from it. And so again, let me see what everybody said regarding this. Bull, bear, bull, bull, bearish, bull, bear, bear, bull, bear, bullish, bullish, bullish. Most people are bullish. Maybe extension plays a factor in people's sentiment today. Again, we still got 2 minutes. Got about 1,000 people here. Again, maybe sentiment plays a factor based off of extension because of how much we dropped yesterday from like Tesla earnings and stuff like that. Like maybe that's what's going on here. You see a lot of people. Normally, I would say people are pretty bearish ahead of Powell meetings. And I would say on average, the market reacts negatively more than positively from Powell talking. Most of the time the market does not like Powell speaking, right? But again, understand, you might be like, oh, well, I'm going to buy puts or I'm going to do whatever. Understand it's never a for sure thing. Like it's never a for sure thing. So just be smart. Like, listen, I choose to stay in a reactionary mindset with stuff like this. Like what I mean is I would rather react to what happens instead of taking a big prediction now ahead of it. So I'd rather react to what happens and then take a position. SPY is technically red right now as well. The previous closing price on the SPY or the S&P is basically 430.20. We're at 430.05. The NASDAQ's still technically green. And again, we got 1 minute left. Again, they haven't started yet. We're waiting here. And again, you can kind of see we're completely live here as well. Sitting back, waiting. Waiting for everything to start up here, team. What have I done? All right, so we are going to throw it in sub-only mode. We are now in sub-only mode. So if you haven't already subscribed, again, still waiting for this to start. And again, just to clarify, y'all can hear the music, correct? Y'all can hear the music, correct? I just want to make sure y'all can hear the music. Everything's clear before we get started. I'm going to close down the music. Okay, good. All right, so again, we're not live yet. Yeah, we're waiting for this to start. Doesn't seem to be started yet. Let me check elsewhere just to make sure.
Here's a number.
Okay, so I just try to make sure video is working. I'm going to also refresh this really quick just to make sure there's no volume coming out. Yep, nothing. Okay, yep. Still live. Still waiting for this to start. Nothing yet here. Check other streams just to make sure. So I could hear people talking, but I just guess my guess is they just haven't started it up yet. Yeah, so. All right. Well, full volume, waiting. Patiently waiting for this to start, team. I'm going to make this a little bit higher so you guys can clearly see it, and then we're going to move this gold chart up a smidge. There we go. All right, guys, waiting, steady. Again, hit the subscribe button. Cute. Yeah, are they having trouble with their live stream? Weird. I think they're having trouble with their feed here. I'm going to report what they're saying. It looks like they're having some type of trouble with their feed. Let me catch other people's. Yeah, so they're reporting on it, but they're having trouble with their feed. Man, they are struggling with their audio today, guys. I'm sorry. Man, dude. Man, their audio is horrible.
Thank you very much for your attention. My name is Bob Steele, and it's my pleasure to welcome you to the 730th meeting of the Economic Club of New York. The Economic Club of New York is the nation's leading for discussions on economic. Over the last 100 years, over 1,000 prominent guest speakers have appeared before the club. Today, in addition to those in the room, it's really a privilege to welcome students from NYU's Stern School of Business, Columbia Business School, Rutgers University, and Mercer University, all of whom are joining us virtually. And we also have the members of our largest class of 2023 fellows. They're a select group of diverse, rising, next generation business thought leaders. Let's give a welcome to all of them who are joining us. Now to the order of the day. Let me welcome back to our club the chairman of the Federal Reserve System, Jay Powell.
Yes.
Jay first took office as chair of the Board of Governors of the Federal Reserve System in 2018 for a 4-year term. He was reappointed to that office and sworn in for a second 4-year term in May of 2022. Jay additionally serves as chair of the Federal Open Market Committee, the system's principal monetary policy-making body. He served as a member of the Board of Governors since he took office in 2012 to fill an unexpired term, and then he was reappointed to the board and sworn in June of 2014 for a term ending January of 2028. Prior to his period of service at the Fed, Jay was a visiting scholar at the Bipartisan Policy Center in Washington, D.C., where he focused on federal and state fiscal issues. From 1997 to 2005, he was a partner at the Carlyle Group. Previously, he served as Assistant Secretary and as Undersecretaries in the U.S. Department of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market, and other related policy issues. Prior to joining the Bush administration, Jay worked as an attorney and investment banker in New York City. In addition to his service on corporate boards, he's made a great contribution serving on the boards of charitable and educational institutions, including the Bendheim Center for Finance at Princeton, and also at the Nature Conservancy of Washington, D.C. and Maryland. Our format today is that Jay is going to begin with some opening remarks, and after he's concluded those remarks, he'll be joined in chairs with David Weston of Bloomberg. David is the anchor for Bloomberg Wall Street Week.
Is there a protest going on? I don't know what they're saying. Does anybody know?
Thank you very much. Thank you.
This stream is chaos right now, dude. This stream is absolute chaos right now, dude. Too bad their sound is terrible, or we'd be... Does anybody know what they're saying? Well, there's nothing really to hear right now. There's some type of protest going on, and there's a bunch of people yelling. Dude, they're fighting. Hey, listen, you want your one-stop shop for finding this stuff, subscribe. Listen, guys, I'm not going to turn this into a plug. I only do this out of the kindness of my heart, but subscribe to the channel. You know, check out our sponsors. I still can't figure out what they're saying. Man, this is chaos. Yeah, I mean, I hope everybody's safe too. I can't tell what's going on. It's too dark. I think they did this intentionally. Man, but this whole stream's just been iffy, bro. Like they actually somebody's yelling. I hear them. I don't know what they're saying though. You know, and again, the actual stream, they have you on hold. Like they're not even showing you, so you're welcome. But I don't know what happened. I don't know what I'm applauding for. So if it's not a good thing, don't judge me because I can't really hear anything just like you. Oh. Yeah, I mean, I cover all these major economic streams, and this is the first time I've ever seen anything like this. So this is, I mean, where's Powell? Is Powell there still? Well, I know they're protesting. I just can't figure out what they're protesting about. I can't hear it. You know. Is that Powell? I can't tell. There's so many old white men with gray hair. I think that's Powell shaking hands right there. I can't be for sure though. Powell wasn't even speaking, dude. Powell wasn't even speaking. He wasn't even saying anything, dude. Which this whole thing is just freaking crazy to me right now. I'm surprised I'm not seeing more news coverage of this, to be honest. Like, I don't see anybody saying, hey, wild protests are going on by the Powell speech. I don't see any of this, man. I don't know what's going on. You can watch the stream right here, dude. We're live on the stream, you know. Well, he made one quote. His one quote, Powell's one quote was this. He said, policy setting committee is proceeding carefully. Significant tightening financial conditions with higher bond yields can have implications for policy. Remain attentive. Policy stance is restrictive. You know, that's what he said. But that's it. I'll put it up in the chat right now so you can read it. But I'm pretty sure this was a pre-statement, not the actual statement yet, because this is live by the Economic Club of New York. And yeah, the whole meeting is basically stopped right now. So you know, very interesting to see what's going on. Hopefully the regular stream gets their sound fixed, which they're still in hold music. The whole thing's chaos. You can see the market hasn't moved an inch, you know. And listen, guys, you know, I'm just going to say this. Like, I do this out of kindness to my heart. You know, I just like helping people. Okay, this might be sarcastic, but like, I just like helping people, you know. You know, I like doing this out of the kindness of my heart, you know, just to help people. You know, it has nothing to do with money. You know what I mean? I would never do this for, you know, money or anything like that. But if you want to check out one of our sponsors, check out TopStep. TopStep is a funded account program for futures in which they give you a demo. They test your skill. If you can hit the target while following their rules, they fund you between $50K up to $150K with a 90% split in futures. If you want to day trade don't put up the money up yourself. I lost thousands doing that, right? You can get started for much less, still have some pressure, still learn how to trade with just less risk in futures. And there's no PDT in futures. You can day trade essentially the Q, essentially the SPY, and what's called the E-mini and NASDAQ. But there's no PDT rule. They are a sponsor of mine. I'm biased in their favor, but the base combine's $49. Again, pure sarcasm in the beginning. Of course I do this for money, but I love you all. Check out my sponsors right here. I'm definitely biased in their favor because they pay me money. But check them out. Great way to help support your boy here in this channel. There it is. Yeah, I don't know what's going on. Again, the actual stream is muted here. So, I mean,
Pardon me?
They stopped the feed, and so now, it's like so anyway.
They didn't stop my feed, lady.
Thank you, everyone. The good news is I'm not going to repeat the introduction. And
All right, we're back.
Off where I was. Jay is going to speak for a few minutes and provide opening remarks. And then he's going to be followed by a conversation with Bloomberg's David Weston. David is the esteemed anchor of Bloomberg Wall Street Week. This conversation is on the record, and we do have media on the line and in the room. Let's welcome Jay to the stage. Jay, for you.
Big Papa, there he is. All right.
Thank you, Bob. Thank you, Bob, and thank you to everyone for being here today. It's great to be back at the Economic Club of New York, where I last visited before COVID. So before our discussion, I'll take a few minutes to discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals, maximum employment and stable prices. And I'll start with inflation. By the time we raised September rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12-month core PCE inflation peaked at 5.6% in February 2022 and is estimated at 3.7% through September. So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%. But these shorter-term measures are often volatile. And in any case, inflation is still too high. And a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains in conjunction with the rebalancing of demand and supply in the labor market has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
All right, so that is Powell's premeditated statements on this. We'll see what this dude says now. And Powell's going to sit down and have a conversation with him.
For being with us today, for the remarks, and for having a bit of a conversation here. Really appreciate it. It strikes me it's a particularly propitious time, given everything that's going on in the world and in the economy. There's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today, we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, you know, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt. So we see policy working, may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing, or in the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house. Quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control. They come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
Well, and we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy? Because it's hard to know how much more you need to do if you don't know how far you've come.
So on lags, I think if you think back, it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't on one. They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long run growth is?
Long run potential growth is not something that moves around a lot over time, but I would, my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable standard longer term estimates of hours worked growth and productivity, which is just output per hour productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, I mean, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. I mean, my guess is it'll be somewhere in the middle, but I don't know. I mean, I think we can say this now. The effective lower bound is not an issue. We were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long
Markets falling.
equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections, and that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates, to the effective lower bound, which is 0 or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to 0 in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And you know, the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, you know, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. Yeah. So are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and, you know, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what do we learn? Sort of an after-action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, other, you know, and central bankers around the world. And there was no playbook. You know, we hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people, and that we wouldn't have a vaccine for 5 years, and we might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, you know, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying did somebody make a mistake, as are there things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, you know, we were in a time of a very long time, in a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have, probably going forward, a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that. And I mean, events are the possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide And it's just not human nature to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly again at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation, and it's also not mainly about shorter term policy moves. So Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer run bonds. So it's really happening in term premiums, which is the compensation for holding longer run securities, and not principally a function of the market looking at near term fund rate. I think a few other ideas about, there are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. There may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, are they the increases in rates? Are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is,
Bottom line, though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
So of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a longer. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane. You're not responsible for fiscal issues. At the same time, you have to take into account. And it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy. Actually, the fiscal authorities have oversight over us and not the other way around. So we stay away from that. So I would just say everyone knows that it's not a secret. And about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. I mean, if there were some vast new fiscal policy that were about to be enacted, and then that would have an effect on the models and have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. There's also a question of who's buying, and we now have one buyer who stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large, they've been buying robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices. And that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see, there's some areas where spending is softening, but overall, I mean, look at the retail sales number. The consumer is strong. Volume is not going up very much, but companies are profitable. Now, if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down. And really, the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on. We had the home builders in this week. It's a very tough time in the whole home building industry, and we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide, and that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver, and this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do, notwithstanding that it's challenging and difficult. And higher interest rates are difficult for everybody.
You have not wavered from your commitment to 2%. You did it again today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they do, they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case. Actually, I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance. And I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What is your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, it was a very tight relationship. And that relationship went down and down and down to the fact where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it and workers expect it, and you expect that in your shopping, then that's what'll happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And the models were all saying that we should be seeing some inflation, and we never saw We never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was built really the collision of very strong demand, really strong demand with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through that now? Where are we in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this: though things have certainly settled down. Certainly have settled down. We see the funding markets is fine. We see, and we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But our job is to be on the case, and we're still on the case, and we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through. With former Governor Tarullo,
Right.
And many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're
a
talking about
proposal.
the Basel III proposal, which is, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about the commercial real estate. There are some concerns out there in the marketplace, what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that? There's something lurking out there that could really affect the system overall, not just the people invested.
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems. But our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is there on them? And what would the damage be to the system if in fact there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar of GDP. But we have, our GSIBs, the largest banks are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities. But we also have these great regionals, and I think they do a great business among, with many companies. And I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question. Are you having a good time? And if so, why?
Now or
No. I assume this wasn't that pleasant, but in general, are you enjoying your job?
I would say this. First of all, it's an incredible honor to do this job, and every day I do it, I feel so fortunate and so lucky and blessed to be entrusted with this. And all I want to do is do the best job I can for the public that we all serve. And yes, there's a lot that's enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell. It's really good of you. Thanks a lot. Thanks.
Bro, how does the volume all of a sudden disappear now? Like, he's like, as soon as they walk away, it disappears. All right, guys. Hey, that was a fun stream, man. Listen, I had fun with that stream. That stream was freaking chaos, dude. That was the weirdest stream I've ever covered that had Jerome Powell in it. And it's not even close. It started off with a protest. I don't know what they were screaming, but the whole thing was freaking chaos. No, really, realistically, it started out with just weird alien-like audio where you couldn't hear a freaking word, right? Then I had to dig around and find a stream that actually worked. And then by the time I found one, it was deeply delayed and the audio was super low. And then finally, when the Federal Reserve put their stream up, it was way ahead. And then the market went up really big and then crashed really big. And then everybody's like, oh no, the market's crashing. And then now we're pretty green back on the day. Gold's ripping up. It's at 1975. Just a chaotic freaking stream. Honestly, just a weird stream. The whole stream was freaking weird. Yeah, the whole stream was just freaking chaos, dude, to be honest. And again, we'll see if we get more stuff like that. Again, I do want to talk about a couple sponsors. Again, I do this out of just the kindness of my heart. But with that said, let's go ahead and talk about my sponsors today. First one is Top Step. If you want to day trade, the futures market is where you should go. Most day traders make the mistake. They try to day trade penny stocks, terrible, almost no edge. They try to day trade cash accounts. You're going to be severely restricted. In the futures market, you can day trade the S&P, basically the Q. In the NASDAQ, basically the S&P and the SPY and the E-mini. And you can day trade short, buy market, buy bid, sell the ash, just like stocks, but there's no PDT rule. It's actually what most day traders do is trade futures. And again, what Top Step does is they give you a demo, they test your skill. If you can hit the target while following their rules, they fund you between 50 to 150K with a 90% split. Just taking the challenge, build your skill. They have free funding coaches and tons of great resources. They've been around for over a decade and pay out millions in actual withdrawals every year. And if you lose, you're only out $49. If you're good enough to pass it, you get a 90% split. So it's the best of both worlds with just less risk, in my opinion. Although I'm super biased in their favor because they pay me money. If you want to check them out, here's the link. Great way to help support the channel. The other sponsor I have is a company called Chart Prime. Again, it's a trading view indicator service. You can use it in stocks, crypto, Forex, futures. And again, look, I get these alerts based off of it because I genuinely use it. But again, speaking of futures, right, I can go to the E-mini, which is basically the SPY. My favorite one is the regular market oracle. And I can also put up chart patterns and stuff like this. Watch how accurate it works if an engulfing candle and a reversal signal shows up at the same point. Like, look, you can go back and back test this. Okay, this one didn't show. Like, we need it within like 3 candles of each other. Like within 3 to 4 candles of each other. Here's the first one, right? Like, look at this. Here it is right here. Beautiful bounce over the next like 30 minutes. Here's another one. Beautiful bounce afterwards. Here's another one. Beautiful bounce. Where's DJ Khaled at? And again, I challenge you to go back and see how accurate this can be. Look, here's another one. Beautiful bounce. Again, look, more than one show up here. Beautiful drop. Look, the same thing. Reversal signal, bullish engulfing candle, beautiful bounce. And again, I challenge you to go back and back test it yourself. You'll realize how powerful it can be. There's also short-term indicators, long-term indicators. Again, you can see chart patterns up on the chart here, right here, where it's actually pretty accurate in terms of the range breaks, and it shows you some really nice momentum. I can use a 1-hour chart, short-term, long-term, Great way to help support the channel. Smart money concepts, oscillators. There's just a lot of really cool stuff. And it's like what? Like I think it's like 40 or 50 bucks a month if you use my link. So it's very cheap. And it's a great way to help support the channel. I'm definitely biased in their favor as well because they're a sponsor of mine. They pay me money, but like there's probably an indicator that they have for you and for how much it costs. Again, try it out. Again, try it out. Very useful. I'll put the link up in the description, as well as the link up in chat. You can also click this banner right here, and it'll bring you straight over to Chart Prime. Again, get you your 40% off, all that good stuff. Again, I can't guarantee you're going to make money. Nobody can. But again, they are a sponsor of mine, so check them out. And with that said and out the way, guys, we're going to go ahead and move over. Listen, don't go anywhere. We're going to do a crypto show today, and literally as soon as we end this stream, it's going to bring you to the crypto show. So you won't have to go anywhere. As soon as we close the stream, it's going to immediately bring you to the crypto show. So stick around. We're going to talk about all the latest crypto news, the grayscale stuff going on, all that craziness that's happened here. And yeah, I love you all. Y'all be safe. Check out all our sponsors in the description. I appreciate y'all joining me here. Again, we cover all the major economic reports, Jerome Powell, FOMC meetings, earnings, all the big stuff. We got a lot of earnings that we're going to be streaming next week, the full calls as well as Jerome Powell press conferences, CPI. We got PCE next week, GDP next week. Tomorrow we got like some earnings that drop. And so pay attention. This starts now. I'll see you guys over there. Good luck. Again, as soon as we close the stream, it should bring you over there. If it doesn't, for whatever reason, just go to this link. It'll bring you there. So if for whatever reason it doesn't like bring you over, again, here's the link. Appreciate the love, guys. Thanks so much. And again, I'll see you guys over at the new stream. All right, guys.